with physical gold tight, to me, this is a player who sold gold without having the real thing. And gold works on confidence. The moment the market believes there isn't enough metal, the leverage unwinds, and violently so. So keep that in mind, that today, with 4 days left, there is 13.5 tons, right, that could very quickly become a very, very big problem that hasn't been delivered yet. We'll see what happens with 4 days left. But it's even, I think, a little bit crazier than that when we take a look at the tighter, more explosive cousin of gold, silver.
Gold's resilience near $5,000 suggests that the floor has once again risen. Each pullback over the past year has found buyers willing to treat weakness as an opportunity rather than an exit. That behavior reflects something deeper than speculative enthusiasm. It reflects a shift in thinking surrounding portfolio construction. Market expert and precious metals trader Andy Schectman underscores unusually high gold delivery obligations on the February contract, noting that with only a few days left, thousands of contracts representing roughly 13.5 tons remain open. He suggests this may indicate that a large short position remains open and unclosed, potentially exposing that trader to stress if the market senses a shortage of physical metal. In his view, such situations can force rapid unwinding of leverage and move prices sharply. Gold has also been under broader upward pressure in early 2026, amid geopolitical uncertainty and shifts in safe haven demand, reinforcing interest in physical metal and futures activity. Turning to silver, Schectman notes far more metal appears to have left Comex vaults than was officially accounted for through February deliveries. It is a sign that physical metal is being withdrawn faster than paper claims suggest. He emphasizes that tens of millions of ounces are moving out of Western warehouses, raising serious questions about who is taking possession and why. Recent market reports show registered silver inventories on Comex have fallen below 100 million ounces, a level that heightens delivery pressure as open interest remains heavily concentrated, with as much as 4 times more paper exposure than deliverable metal. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Andy Schectman's recent interview.
Let's talk about gold first, and then we'll talk about silver. So in terms of gold, right, you have 4 days before February gold has to deliver. Now, much of the February gold has already delivered. Typically, the first day that the contract goes off the board, which would have been the end of last month, January, those who are holding contracts stand for delivery. But there's been a lot of contracts that throughout these months that buy during the delivery month and take immediate delivery. And there have been others that have been hanging on. But with 4 days to go, there's still 4,366 contracts open, or 436,600 ounces of gold, 13.5 tons. Now, that's insanely high, Adam, for this late in the cycle. It's 24 times normal, right? And even bigger than the upcoming March contract, which we'll talk about. But this is a massive red flag. And to me, what it means is that someone is really short and they haven't closed out for weeks. And this typically would be the hallmark of selling gold you don't have. If they were planning to buy it back, they're now trapped, because the liquidity this late in the contract is very thin. Everyone's already moved on to March or even to May on the contracts. So with physical gold tight, to me, this is a player who sold gold without having the real thing. And gold works on confidence. The moment the market believes there isn't enough metal, the leverage unwinds, and violently so. So keep that in mind, that today, with 4 days left, there is 13.5 tons, right, that could very quickly become a very, very big problem that hasn't been delivered yet. We'll see what happens with 4 days left. But it's even, I think, a little bit crazier than that when we take a look at the tighter, more explosive cousin of gold, silver. And in silver, one contract equals 5,000 ounces. Here's the interesting part about the February contract before we get to March. I don't know that I've ever seen this before. So Comex silver is leaving the vault faster than the February 2026 contract is asking for delivery. What do I mean by that? So far, for the month of February, cumulative deliveries have been 4,639 contracts. That equals 23,195,000 ounces. All right, so those are the deliveries, right? So for February, we saw 23 million ounces of silver delivered so far. However, here's the interesting thing. What does delivery mean? That means there's a paper contract, and you usually, when it comes due, you can cash settle, give me money, you can roll it forward to the next delivery month, or you can stand for delivery. So when stand for delivery, there's two categories. This is really important to understand. Inside the Comex walls, right? I have 8 Brinks facilities that we work with. Of the 8 Brinks facilities, one is Comex. It's JFK, New York City. In that facility, I have clients with millions of dollars worth of 1,000-ounce bars. They're an eligible category, not for sale, but eligible to be moved to the registered category for sale, right? So when you hear of all these deliveries, delivery could come in and move to eligible. It is no longer for sale. It's held in a Brinks vault or a Delaware depository or CNT. These are all Comex facilities. It's there. It's not for sale. It's eligible. I'm holding it. But the registered are the bars backing. So, okay, great. That doesn't mean that it leaves the facility, right? So let's go back to what I was just saying. There have been 23,195,000 ounces that stood for delivery in the month of February. And there's 4 days left, and then it's over. And then we go to March. Here's the interesting thing. The actual February withdrawals, the metal that left the vault, is 164% higher than the February 2026 delivery. 38,082,934 ounces have left the building. Elvis has left the building. 38 million ounces left, 23 million ounces were delivered. How does that work? They're taking more metal off the exchange than is even being delivered. They're pulling metal out of maybe the eligible category. It's leaving. That metal's never coming back. When you move 38 million ounces by truck out of the Comex warehouses, you think that stuff's ever coming back? Who's taking possession of 38 million ounces? This is what I've been screaming. And this is all that matters. If a 500-ounce mint box weighs 42 pounds, who just took possession and left the warehouse for almost, over 38 million ounces? Think about that for a moment, about the logistics that is involved in it. Now, I think it's the Exchange Stabilization Fund. Like I've been saying, for 16 straight months, we've seen these kind of deliveries and withdrawals for 16 straight months. Not one person in the mainstream asking this. All they talk about is the price and the BS fundamentals where they paint negatively. Never do they say, Johnny, forget about all that. I want to know who the hell's standing for delivery. Where's it going? This never happens. This is all that matters. And the lack of journalistic integrity, the one half truth, but missing the whole story. And do you think, Adam, that there's any coincidence that after all of these months of delivery and all of these months of metal being pulled off the exchange, just by coincidence, it's now critical mineral. We're going to call it critical. And we're going to put a state-sponsored price floor under it. And you know what? Just for good measure, we're going to accumulate a strategic stockpile.
Andy Schectman argues that large, opaque state actors are likely active within major exchanges, similar to what he believes is happening on Comex. He questions who is consistently standing for delivery on billions of dollars worth of metal each month, suggesting that the scale points not to private investors, but to sovereign-level money, potentially U.S. Treasury-linked funds or stabilization mechanisms. Moreover, Schectman also claims that in China, gold accumulation is not limited to the People's Bank of China. Various government ministries and state-linked entities may purchase gold independently, allowing significant volumes to be acquired without full disclosure to institutions like the IMF. In his view, this decentralized method of buying enables ongoing strategic accumulation while avoiding transparent reporting, reinforcing the idea that sovereign players could be quietly building positions in physical metal. China is undergoing a significant, long-term strategic shift towards gold, driven by the central bank's desire to diversify away from the US dollar, bolster geopolitical resilience, and meet surging, crisis-driven domestic demand. As of early 2026, the PBOC has continued to increase its gold reserves, contributing to a record-setting global gold market. Let's jump into the interview.
There's definitely state players within the exchange, just like there is now on Comex, where who the hell's standing for delivery for billions and billions and billions every month,
Right.
with no one asking that question, but it seems to be me. And that's money that is far bigger than anyone that you can even think of has. This is state money. This is exchange stabilization, U.S. Treasury money that is standing for delivery for billions every month, as far as I'm concerned. And the same thing would be true there. You have sovereign wealth funds and state players that are buying and on behalf of or commercial banks buying on proxy for who. So anyways, bottom line is that, yeah, even though it's not completely state run, it's administered, the regulations by the state and by the government. And I'm sure there are, government actors in there that are opaque, maybe, that are being run by a bank in China on behalf of, one of the things that's interesting when you look at the way China accumulates gold and has for years, they have all these ministries, Ministry of Education, Ministry of Defense, and they all own gold. It's not just the PBOC that is accumulating it. When the People's Liberation Army buys it, or the Ministry of Economics buys it on behalf of that group, it's not reported to the IMF. Now, ultimately, it's all of that's probably going to flow to a certain point at some point, but it allows them to continue to accumulate stuff all the time with, and by the way, voluntarily is the reporting requirements. There is no real reporting requirements. They voluntarily give that information to the IMF. So they'll 1 out of 10 ounces maybe that the PBOC buys, they'll report to the IMF, but the rest of it, the 9 out of 10 is bought by other agencies within the government that technically, they can feel good about not reporting it. It's just a way to sidestep the reporting requirements. I don't know who the dummies are that are sending it. They are from the West. I mean, but here's the thing. The thing of it is that also that these contracts allow for delivery. Now, I'm sure there are some traders throughout the Western infrastructure that are silly enough to do this. Why not? I don't know. Part of the making it critical mineral is the ability to limit or completely disallow exports. We haven't got that far yet. But I do think on a state level, I would probably see that the majority of the big traders in the United States are not doing it right now. But that doesn't mean it's not happening all through Europe, all through the West. Maybe there are some in the United States that are. I don't know at that level. That's very, very almost impossible to see who's doing it. But it's enough to where you can tell it's still happening because the arbitrage window hasn't been closed. If no one was doing it, they wouldn't leave it open as long as they have. It is happening, and a lot is flowing that way. Who's behind it? Don't know. We would like to hope that the U.S., the people aren't that stupid. But, we have never done this until this administration. I've never seen this ever before in 35 years. I've never seen anything like this. This is so far an outlier to anything I've seen my whole career. I can't even begin to tell you. So I would say we weren't doing it right. The rest of the world was exploiting the paper price, and it started with the BRICS. Think back to when you were a kid, Adam. India and China were third world, right? And they were. And Russia was certainly not going to challenge the Western markets. And these countries that make up the BRICS, they would have no interest in challenging the Western hegemony. No one in the West did it here. So they had the ability to control the prices forever. And creating this illusion through price that silver was so abundant and irrelevant, why would anyone care? It was the ability to create a perception of reality through futures contracts. Now, these countries in the global south are coordinated and motivated and sophisticated. They understand the math very well. They see the long game very well. And the part that people can't deal with, again, is what I said earlier, the amount of time it takes for them to do this the right way, playing the right game. The long game is something that is dismissive by the mainstream media. They don't get it. And even a lot of people who would look at this and say, well, why not just spend $3 trillion and buy it all? 10 trillion. Why not? Because if you do that, you cut off your nose to spite your face. You would blow up the market like that, and everyone would know what you're doing. But instead, if you use proxy banks, if you use, the Globex market, which allows you to do this quietly, it gives access to Comex with a lot of anonymity. You use sovereign wealth funds, and quietly the death by 1,000 paper cuts. That's what they're doing, and you see it. It's happening everywhere in Shanghai, in Comex, and in London, and it's going to accelerate. And thank God someone got to this administration and said, "Y'all, look at what's happening. We're going to lose this race.
Right, don't be left behind."
Yeah. Yes, and all the paper promises in the world don't do you any good. It's like I always say to people: if things get bad, do you want stock in Kellogg's or boxes of Frosted Flakes? That's kind of the dichotomy there.
The gold market continues to consolidate as it gets comfortable around $5,000 an ounce, and while it still has some significant ground to cover, Friday's solid rally is a reminder of why you don't want to bet against the precious metal in 2026, especially ahead of the weekend. The relative strength index remains comfortably above the 40 level, typically considered as a key support in sustained bull markets, indicating that underlying trend strength has not deteriorated. If sovereign players are steadily absorbing physical metal while paper exposure remains elevated, are we approaching a turning point where physical demand ultimately sets the price of gold and silver? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.